Okay, so you know how sometimes like you're looking at your investments
Mhm.
and you see the market just going up and up
Yeah,
and you're like, "Oh man, did I totally miss out here?
right.
Should I have gotten in like way back when?"
It's a common feeling, for sure.
It is, and it's something that I know I've thought about. A
Yeah,
lot of people probably listening have thought about this too.
absolutely.
So today what we're going to be doing is like a deep dive into this whole like fear of missing out,
Yeah,
especially when it comes to investing.
right.
Like, is there something to that feeling?
Mhm.
Or is it like, is there a different way to look at it?
Yeah, is there something we're not seeing kind of a thing?
Exactly.
Yeah.
So we've got some interesting sources here that really challenge this idea that
Right.
we have to perfectly time the market.
Interesting.
Like they're suggesting that being in the market
Mhm.
is actually way more important than like trying to pick the exact right moment.
You know what's funny is that this idea that the market is too high,
Wow.
it's kind of a constant worry,
Yeah.
no matter what the market's actually doing.
It's like we're always waiting for that other shoe to drop.
Right, exactly. Like a downturn is always right around the corner.
Yeah.
And it
Yeah.
makes people hesitate, you know?
Yeah. And so then that makes you wonder, like,
Mm-hmm.
is that hesitation actually like hurting us in the long run?
Potentially. Yeah.
Like, are we missing out on games?
Yeah. Are we shooting ourselves in the foot by waiting?
Right, exactly.
It's a good question.
And the thing is, you try to predict these short-term market swings.
Right.
It's almost impossible.
Yeah, it really is.
Like even for the experts.
Even the people who do this for a living,
Right.
you know they get it wrong all the time.
Because there are so many different things that are affecting it.
Oh, yeah. You've got global events. You've got economic indicators.
Mhm.
Investor psychology even plays a huge role.
Oh, totally. And that's like impossible to predict.
Right, exactly. There are just too many variables.
Yeah. And one of the sources we were looking at, they had this really cool visual. I thought this was really interesting. They were showing how
Uh-huh.
a point in the market that seems like super high right now,
Okay.
years down the line, might look like nothing,
Yeah.
like a little blip
That's a good point.
because of the long-term growth trend.
Yeah, it's all about perspective.
Right.
And this is where that whole idea of compounding comes in.
Okay.
So think of it like this. You've got a snowball
Mm-hmm.
rolling down a hill.
Okay.
It starts small, but the longer it rolls, the bigger it gets.
Right.
And it starts picking up speed and size like exponentially.
Yeah.
So in investing those early investments, even if they seem small at the time,
Right.
they're like that initial snowball
Yeah.
and they can really build up over time.
I like that analogy. That makes a lot of sense.
Yeah.
And, speaking of starting early, there was this quote from one of the sources
Okay.
that I thought was really powerful. It said the best time to plant a tree was 20 years ago.
Mhm.
The second best time is now.
It's so true.
It's so simple,
Yeah.
but it really hits home
Yeah.
for anyone who's thinking about investing,
Right. It's like, don't wait,
Yeah.
because the sooner you start, the better.
And I think that quote really gets at that idea that, we can't change the past.
Nope.
But we can control what we do right now.
Exactly.
And I think some people might say like, well, shouldn't I wait for the market to dip?
Yeah, that's a common thought.
Like, wouldn't it be better to buy stocks when they're cheaper?
Sure, theoretically, yeah.
Yeah, and get more for your money.
Right. Buy low, sell high. That's the saying, right?
Exactly.
But the problem is that
Yeah.
trying to time the market perfectly is almost impossible.
It's really hard.
Yeah, so you could end up waiting and waiting
Hmm.
and miss out on all that growth while you're sitting on the sidelines.
Right.
And then even if you do manage to buy low,
Yeah.
knowing when to sell high
Right.
is a whole other challenge.
Right. It's like picking the top and the bottom.
Exactly. And that's incredibly difficult.
So it seems like the main takeaway here is patience
Yeah.
and having that long-term perspective.
Mm-hmm.
Like the sources are really emphasizing that the market is going to go up and down.
And it fluctuates.
It's going to fluctuate. That's part of
Well,
it.
that's normal.
And it's not about trying to outsmart those fluctuations.
Yeah, right.
It's about riding them out.
Exactly.
And one of the things they said was that, decades from now,
Mm-hmm.
these market highs that we're seeing today
Right.
might just look like a tiny bump
Yeah.
in a much larger upward trend.
It's all about perspective.
It is.
Like, imagine that.
Yeah.
What feels overwhelming today,
Uh-huh.
years from now, could just be like a little blip
Yeah.
on the radar.
That's a good way to think about it.
Yeah.
So for people who are like, maybe a little bit intimidated
Sure.
by the way the market is right now,
Yeah.
what would you suggest? Like, how should they approach this?
So one strategy that can be really helpful,
Okay.
especially when you're worried about the market being too high,
Uh-huh.
is dollar cost averaging.
Okay. I've heard of that.
So basically,
I don't really know how it works, so.
okay, so basically you invest a fixed amount of money
Okay.
regularly,
Okay.
like every week, every month, whatever works for you,
Okay.
regardless of what the market is doing.
So even if it's like way up high.
Even if it's way up high, you just keep investing that same amount.
Interesting.
And what this does is it helps you average out your purchase price over time.
Okay.
So you're not buying everything at the highest point.
That makes sense.
You're buying some high, some lows.
Yep.
And it just smooths things out.
And that takes the emotion out of it, too.
Yeah, exactly. It's less about trying to time the market
Right.
and more about just staying consistent
Consistency.
and letting time do its thing.
Yeah, so it sounds like we're kind of shifting our thinking here.
Mm-hmm.
Like, instead of asking, is the market too high? The question should be, how can I get started building that snowball
Right.
and benefiting from the power of time?
Exactly. Because like we were saying before, time in the market
Yes,
is really what matters most.
I like that.
So instead of worrying about whether you've missed the boat,
Yeah.
maybe the question to ask yourself is, how much longer can I afford to wait?
How much longer can I afford to wait?
Because every day you're on the sidelines,
Yeah,
that snowball's not growing.
right.
You know what I mean?
I do.
So that's something to think about.
Those are some really great insights.
Yeah.
I appreciate that.
Yeah, no problem.
I feel like we've learned a lot today.
Yeah, I think so too.
I mean, it really does seem like that old saying is true.
Mm-hmm.
Time in the market beats timing the market.
Absolutely.
So don't let, like, fear
Right.
keep you from starting your investing journey.
Yeah, don't worry about hitting those peak valuations or, record-breaking levels.
Yeah.
Just start investing.
Just get started.
And,
Yeah.
just a final thought here.
Okay.
Perhaps the most valuable asset in your portfolio isn't actually a stock or a bond.
Oh, interesting.
It's your time and the power of compound growth.
Powerful stuff.
Yeah.
Well, thanks so much for joining us today.
It was my pleasure.
It was great having you.
Likewise.
And for everyone listening, we'll catch you next time for another deep dive.
See you then.
Bye.